Many of you have let me know that you are waiting for either the real estate market to crash or for interest rates to come down before you will consider buying a home. And in today's video, that's what we're going to talk about. I've been a realtor in the Central Florida market since 2009, and I feel like at this point I've seen just about everything that we could possibly go through in a real estate market. I got licensed just after the summer of 2009, and my first full year in real estate was in 2010. And I just looked on the MLS yesterday to see, what it was like in 2010. And I sold 18 houses that year, which was great, but I was shocked at my total gross just sales volume. It was $2.5 million. So that works out to about $140,000 per house average. And that even seems high. I feel like I was selling a lot of $80,000 houses with the occasional incredible $300,000 purchase price from time to time. But that has changed significantly since then, hasn't it? What I want to say is I really feel like Florida has gone through extremes. When prices dropped in 2000 and roughly 9, 10, they dropped to an extreme level, further than they were in other parts of the country. And I mostly mention this because what I want to get into a little bit is sort of buyers and sellers' mindsets and a little bit of the history of what we've gone through here in Florida over the last decade or so. So as I mentioned, I'm a realtor in the Central Florida area, which is the greater Orlando area. My name's Krista. If you would like to reach out to me as you're watching this video or after this video, there's always a link to my calendar underneath the title. You can click on that and set up a time to talk to me, or feel free to just send me an email or shoot me a text. Now, without further ado, let's jump into it. So a lot of people want to draw a parallel between the 2009, huge crash recession and today. And they're waiting for that bubble to burst, for the housing prices to drop significantly. And I would like to recommend, if you haven't done so, find the movie The Big Short. It's really entertaining, it's very complex, and it packs a lot of information into it. So if you're gonna have a glass of wine, this isn't maybe the movie for it. You're gonna be rewinding and then possibly starting over on a different day. It stars Steve Carell, and it's very entertaining, but it will give you a good picture of what was going on then. But in a nutshell, back in 2008, 2009, around that time, Wall Street investors were clamoring for mortgages to invest in, and they were being given out left and right to different consumers, different borrowers who maybe weren't necessarily totally qualified for them, and the quality control checks simply were not taking place that should have been. In addition, buyers were being sold adjustable rate mortgages, and they weren't necessarily being explained what that meant. So they would get a mortgage rate that was very low, but it was an introductory rate. It was a teaser. And then after 2 or 3 years, it was going to reset. And in this case, it adjusted upward. So homeowners found themselves in this position where their interest rate had adjusted, their monthly payment had gone up, and maybe they were perfectly well qualified for the original teaser interest rate, but they were not qualified for the new rate. And to make matters worse, they couldn't refinance because they didn't have any equity in their homes. And so people started walking away from their homes. And as an aside, I think the adjustable rate mortgage definitely has its place in the marketplace, and it can be good if you understand what you're getting into. But I think people are very, very afraid of them now because of what happened then. But it is another way to get a lower interest rate, at least for a period of time. But you have to understand what you're doing. So after that, I don't know what the percentage was, but most of the houses that I was selling in those years were either short sales or foreclosures. So people were just walking away from their homes. And if somebody's not paying their mortgage, they're also not maintaining their house, because why would they if they know they're going to lose it? The courts were so backed up that it was taking 3 years for foreclosures to go through, so people were living in their homes without paying their mortgage, without maintaining the homes. The homes were in terrible shape. The prices dropped to rock bottom. I mean, I can remember selling $30,000 houses and $20,000 condos. It was a real crisis. To make matters worse, so we had this weird foreclosure issue going where people were living in the home for years and years and not maintaining it. But we also had these short sales. If you don't know what a short sale is, that is when the loan holder or the lender agrees to sell the house for less money than what is owed or coming up short. So those were taking, if you went under contract on a short sale, it could easily take 6 to 9 months before the bank would even answer to let you know if they would accept your offer. Meanwhile, the homeowner is sending in documentation to prove that they can't pay their mortgage, and they dragged on forever and ever and ever. I very much hope that we never go back to a period of time like that, because it was so difficult to get up to purchase a home at that point in time. And things would go under contract, people would wait, then they would get tired of waiting and they would leave, and then you'd have to find another buyer. it was not a fun time. Bargains could be had, but you definitely had to put in some work to get those houses back into shape. And let's not forget, in the case of foreclosures, that some people were taking their anger that they felt towards the bank who was going to foreclose on their house, they were taking that anger out on the house. So you'd walk into a property that had been foreclosed on and the walls had holes in them, and the toilets were missing, or the bathroom sinks had been ripped out. I never saw this, but I heard in some cases people were flushing cement down the toilets, or that could possibly be a problem. Let's not go back to that, I hope. So let's move forward to today. So we still have people living in those homes that they bought back in 2010 all the way up to, we were still feeling the effects of that in 2017 probably. So we still have homeowners who are living in those homes that they got for incredibly low prices. They have a ton of equity in their homes. You can barely find a house in Central Florida right now for under $200,000, and $200,000 was a pretty high price back in those days. So they've got plenty of equity in their homes. There's very little reason for anybody to go into foreclosure or short sale right now. It would be silly to stop paying your mortgage and not sell your house and take the equity out of it. So we're just not seeing the foreclosures right now. So to go back to my earlier point about the mindset of buyers and sellers, I think some buyers are still expecting that prices are going to drop down to that level again because they saw it before. But there's no reason for that to happen. There would have to be some sort of an outside force that would cause that to happen. In 2008, we had the adjustable rate mortgages and no equity in the homes. Nowadays, we have equity in the homes. What I do see happening though is sellers who are thinking back to what was happening 2 years ago, right? When you could list a house and have 20 offers at the end of the day, the first day on the market. They're looking at their neighborhood and saying, okay, that guy down the street sold his house for $550,000, 2 months have passed. My house is therefore worth $575,000 because that's what they're thinking of, from just a couple of years ago, because that was kind of a realistic scenario, unfortunately. Or you could list it for the same price as the guy that sold it 2 months ago, and you'd have offers way over the asking price because it was so competitive then. So now we are seeing that sellers are having to sell. It takes longer to sell a house, and they're having to do price reductions. Unless there is some outside force that causes something drastic to happen here, what I see happening is sellers having to readjust because buyers are much more cautious now. And here in Central Florida, I can only speak about Central Florida really, we do not have an inventory crunch. I know that there are some parts of the country that face many challenges with inventory. We have inventory, so we're seeing prices come down bit by bit, incrementally, until buyers are willing to buy. In terms of there being some sort of a massive crash that's imminent, I don't see it happening unless there's some sort of an outside force, which I can't predict. It could happen, sure, but I think everything is moving along, fairly well. Just sellers have to be a bit more realistic in their pricing expectations. Now let's talk about the other side of this that a lot of people are waiting for, and that is the interest rates to drop. So let's jump back to 2023 for a minute. There was a lot of talk that the Fed was going to cut rates several times throughout 2024. And so a lot of lenders decided to go ahead and drop their interest rates to consumers. And I think it got down into the 5s in December of 2023. So a lot of buyers got ready to buy. A lot of sellers put their house on the market thinking, okay, finally now we can sell, and then we can get a decent interest rate somewhere else and we'll be okay. And then that didn't happen. The Fed didn't cut the rates, and so lenders brought their rates back up, and a lot of people who were gearing up to buy suddenly found that their monthly payment was either too high, or they didn't qualify, or they didn't qualify for the house that they wanted. And so it was just a rough start to the year this year. 2024 got off to a slow start. So now a lot of people are waiting for the interest rate to drop again. And we can, to a certain extent, predict what's going to happen with the interest rate. We have to look at things like the inflation rate, because that's what the Fed is looking at. The Fed is heavily driven by the inflation data. Of course, it also looks at jobs, job rates, job creation, but right now it is very heavily focused on inflation. So in most parts of the country, we still have very limited inventory. And when there's limited inventory and there's demand, the housing prices continue to go up. And that puts additional inflationary pressure on the Fed. And that means that they need to keep their rates higher also. So that's kind of where we are. If we see inflation data going down, if we see the numbers going down, then the Fed will cut rates a little bit. So we don't know the future. We can't exactly predict everything that's going to happen, but this is data driven. You have to keep your eye on the inflation right now. As long as the inflation is high, they have to keep the interest rates high to slow down that growth. That's the rate at which they lend money to banks, and that is the best way that they can slow down this inflation. It's a really difficult decision, I suppose, for them to know exactly what to do, because if they raise the rates too high, then they'll kill demand completely, and that'll set us into a recession. If they cut the rates too quickly, then inflation can get out of control, and then they'll have to raise the rates again and do additional damage to the economy as well. Anyway, if you want to know where the interest rates are going, you want to pay attention to the inflation reports. Some analysts are predicting that the Fed will cut the rates in the fall, and the Fed is supposed to be an apolitical institution. However, it is going to be based on what the inflation rates are. So we will have to see what's going on then. So if you hear people saying that they're going to cut the rates around the election time, it is not supposed to be based on the elections. It's supposed to be based on what the inflation rates are doing. But keep your eye on that if you are following the interest rates closely. By the way, other analysts are saying that the rates aren't going to change very much at all in 2024. So depends who you're looking at, who you're listening to. I am filming this video on May 2nd. The Fed met on April 30th and May 1st, and they did not lower interest rates, which is good because that would have driven up inflation higher. And so I think borrowers are going to have to get used to, we're going to be over that 7% for a while yet on 30-year mortgages. So if you are, again, waiting for the interest rates to drop, there's like a real estate meme that's kind of making the rounds where it says, if you were waiting, I'm looking at data on my computer, if you were waiting in 1973 when the average 30-year fixed rate was over 8%, if you're waiting for that to come down, I mean, by 1981, it was up to 16.63%. You would have had to have waited until 1993 to get down below that 8%. It dropped to 7.31% in 1993, so 20 years. My advice, if you have to move, is always get the best deal that you possibly can when you're buying. Look for the house that everybody else is overlooking, that has the bad photos that people aren't looking at, or has a weird smell. Something that you can fix where you can get that better deal. In terms of interest rates, I mean, refinancing is always a possibility if they come down. I would be more focused on the price of the house and getting that best deal that you possibly can. Thanks for watching, and I'll see you next week.